lack of cash will put a damper on Christmas celebrations for many this year. There are concerns about the health of consumers across the world, given the fact that prices are soaring and central banks are raising interest rates to deal with the inflation. A report released recently by 80/20 has its credit stress report that has been released for the third quarter of the year, and it shows that total defaulters are actually down by 3% in South Africa. But the strategy and research company says a more detailed view of the credit market shows that large pockets of consumers are facing financial distress, and it looks at some alarming trends. To discuss, we're joined by the director at the research and strategy company 80/20, Andrew Fulton. Mr. Fulton, thank you for being with us. You say there are alarming trends in the four most credit active customer segments. What are those and what are the trends?
Yeah, no, thanks for having me. So what we've done is we've created a segmentation of the credit active South Africans. We've created 8 segments with 46 subsegments, and the 4 on the top, the sort of wealthiest segments, are the mass credit market, the middle class, the heavy hitters, and the comfortable retirees is the names we give them. The middle class is about 4.3 million people, and the heavy hitters, the sort of wealthy South Africans, are the top 5%, 1 million people. And while, you know, as you said, defaults are down for these segments, the real issue is just how much interest rates have gone up and how much pressure that's put on mortgage payments and car payments, how much money that's taking out of the economy just to service debts.
So defaults may be down now, but is this an indication of something worrying on the horizon?
Well, I mean, it's defaults are down because there's a lot of loans with retail credit, unsecured loans, and so the defaults are down because of the large number of loans. It's with the interest rates, basically what that's doing is let's give an example. If you think about somebody who's, say, 25, 30 years old, waiting to get into the property market, in 2021, they would have seen the lowest interest rates in a generation. So, 7% prime lending rate. They would have been foolish to not buy a house if they had means. But now that we've had 3.5% increase, 3.5 percentage point increase in our prime lending rate, those people are now, if you bought, say, a 1.5 million rand property in Cape Town, you'd be needing to find about 3,100 rand extra per month just to hold on to that house. If you had vehicle asset finance, you'd be finding even more money to pay for the car. So that's where the pressure is really happening, is where people are going to find this money to continue making payments. One of the things that we realized, that the middle class, these sort of 4.5 million people, 66% of their income on average goes to just servicing debt. So if you're making that, the average income for that segment is about 10,000 rand a month, 6,600 is going to servicing debt. The rest of that cash, you've got to feed your family, clothe your family, pay for school and entertainment and Christmas presents.
And if you are just making ends meet and things are just working, 3,100 rand can make a huge difference and push you over that edge, right?
Absolutely, yeah. And so what, obviously South Africans are extraordinarily resilient, as we can see in the face of electricity and the history of the country. But one of those coping strategies that we're seeing right now is people are extending that debt on credit cards. So once again, for the middle class, we've seen that credit card debt rise by 9% in a year. For the mass credit market, which is 11 million people, their credit card debt's gone up by 12% in a year. So those are the worrying things, is like, how much can that system contain, and then things start toppling over. We've heard a lot about the black middle class that kind of grew dramatically in the past decade. The recession followed by COVID moved millions of those people out of the middle class into the lower classes, and a lot of that middle class lifestyle was funded off of debt. And a lot of these people were about one paycheck away from falling back into the lower classes. So we're seeing a lot of that movement, and in addition to that, strain on consumers.
So often the rich are more resilient. We've seen times when the rich really do get richer, when everything seems to be falling apart. Are you seeing that resilience at the top?
Yeah, I mean, we saw that through COVID, that generally if you had money, you did okay. If you had generational wealth, if you had savings, you got through COVID, because, for that segment of the population, they weren't spending money on international travel. They weren't spending money on petrol, new clothes, all sorts of things. So they actually came out of COVID with a relatively decent amount of spending power. The problem for them, though, is now those assets that I've been discussing are under pressure. So maybe they bought a second house in 2021 or investment property. We know South Africans love their cars, and for those upper classes, you have 40%. The vehicle asset finance debt is 40% of the home loan debt, which is maybe a questionable way to spend your or to borrow money. But yeah, we're seeing even at the top, they're under pressure. We have a metric that we use called debt newly in default, which means this quarter the debt that went into default. We track that every quarter, and we saw that debt newly in default for the heavy hitters, that top 5% of South Africans, went up by 10% on last year. So yeah, there's pressure across the board.
Yeah, and a lot of people would say don't buy a really fancy car unless you can basically pay cash for it. Otherwise, it really doesn't make sense. Very quickly, we've run out of time, but there are comfortable retirees, you say, and people who are living off interest should be doing pretty well. But of course, we don't have enough of those, do we?
Yeah. So that's the one segment that's probably doing better than others. The comfortable retirees who, they came out of professional jobs, they probably had pretty decent pensions. They're the only group that's actually benefiting from this high interest rate environment, because if they've got pensions or investments, they'll be getting more money now. So they're doing okay. But what we've also noticed is they're taking out unsecured debt in order to make ends meet. But yeah, that segment should be okay because they're downsizing, they're getting into smaller houses, they're probably getting rid of those expensive cars. So yeah, that's the one segment that's going to be doing relatively better than the other ones we're looking at.
All right, looking at the state of consumers and our credit activities, Andrew Fulton, thank you, Director at 8020.